This is the Daily Market Rundown live from the Tradelo Trading floor. It's January the 10th. Some highlights from today's show. UK yields pause for a breath. Non-farm payrolls has potential for fireworks. And the 2's-10's curve is sending a warning signal. Good day, traders. Let's get stuck straight into it. Looking at some of the overnight moves. Of course, yesterday was a US holiday. Looking at some of the overnight markets, there's not a great deal going on, of course, as we move into the non-farm payrolls. But some standout market moves is very much the oil. Quite a bit of volatility and volume there. Another day of up moves. Will it hold? Well, we have run into the 200-day moving average now to the upside, so it'll be a very interesting day for oil. I suspect we will see some pairing of positioning today, so keep a close eye on that. Definitely a market to watch quite closely. Now, if we move across and have a look at some of our headline news, we're going to start off and talk a little bit about the UK. Of course, over the course of this week, we have seen UK yields in general jolting higher. Now, looking across the sort of the spectrum of what's causing this, yes, there's some finger pointing towards the Labour government and their policy stance, but I think it runs a little bit deeper than that. I think there's a number of different sort of reasons we can assign to it. I think at the core of it, of course, what we have to consider is that the UK at the moment, from a growth perspective, it's simply just not growing. At the same time, of course, we do have a government that is trying its best to stimulate the economy, and we also have the central bank that's talking about rate cuts at a time when inflation is still very elevated. So you have this combination of a low growth, a negative growth scenario combined with a high inflation and a central bank that's trying to cut. And that is sort of the recipe of stagflation. And we all know that bond investors do not like a stagflationary type environment. And that's why we've seen this week, yields popping quite a lot higher and the pound creeping a lot lower. Now, I think the key takeaway from it is at a fundamental level, okay, we take a step back and look at fundamentals. What has really changed, over the course of this week in comparison to November, December last year? The short answer is absolutely nothing. Perhaps it's very much a little bit of early year sentiment towards the UK. And so the reason I mention that is because, it's going to be a very interesting couple of days now in the UK markets. We, of course, have broken above that 473. And I think a lot of the move we've seen this week is just simply because of the result of breaking above that 474 yield level. So again, I think it goes to be said that we're going to need to see a little bit more trading to declare the UK in some form of a fundamental problematic situation. So for now, very much keep a close eye on this. I expect we're probably going to drift a little bit lower at the start of next week. Should we hold on to that level and yields start to escalate, by all means, the fundamental landscape will shift very quickly. Pound will sell off as a result of that. However, should we reclaim that 475 level, don't be surprised to see that pound pop back up and take back a lot of the sell-off we've seen in the last couple of days. Okay, so it's one to watch. I think that's the key takeaway. It's not that we're going to fade it. We're not looking to suddenly become, sort of heroic buyers of gilt and heroic buyers of pounds. We simply just want to watch it closely because right now there isn't really a fundamental driver as to why the UK is experiencing the kind of turmoil we're seeing. Now, let's shift across and talk about the non-farm payrolls. It is NFP day. It's the first one of the year. And let's talk about some of the key scenarios. As we move into this, there's two little interesting points that I think have come via the Reuters news. One was from an economist at BNP Paribas saying that effectively, if we go and compare, sort of the impact of tariffs, or when Trump came into power, if we go and have a look at, when did Trump's policies actually begin to have any kind of positive impact on growth and the economy in the US, what he was kind of saying was it didn't come directly after the election. Okay, keep in mind Trump is not even the president yet. We still have 2 weeks to go until that. So what he's leaning on is we're not going to really see the positive impact of Trump policies until such a time that Congress actually passes them. Okay, so I think that matters because this idea that everything's going to be hunky-dory and we'll just keep growing and everything's going to be great under Trump. Well, yeah, sure, but we actually need to see what policies he implements, and that's still going to be a good 6 months away. So just factor that in. The market is very hyped up on Trump still, so just factor in that there is a bit of a delay as to when we're actually going to see some of that benefit come in. Now, the other part that I thought was very interesting was, if you look at the last two non-farm payroll prints, in terms of a rounding error from the unemployment rate, it's been a very, very close call. Okay, if we go and have a look at October, we had a 4.1 print, and in November we had a 4.24 print, which could have very, very closely been a 4.3 print, which, as you should remember, was the highest print for unemployment last year. So I think the key takeaway from the unemployment rate print today is just keep in mind there is that potential for us to print 4.3 and even perhaps higher. Okay, I think that's the key takeaway, is that there is a little bit of nervousness, particularly around the unemployment rate over the non-farm payrolls today. So let's begin there. Let's talk a little bit about unemployment rate as well as some of the scenarios for non-farms today. Now, first thing to note, the thing that scared the living daylights out of both the markets and of course the Fed last year and prompted them to cut 50 basis points was when the SAM rule got triggered. What's the SAM rule? Well, we look at what the 12-month low is, or 12 months ago what the low print was. We then effectively take the average of the last three prints, which is currently sitting around 4.13, and effectively when that average crosses at least 0.5% higher than the 12-month low, ultimately we have got the SAM rule triggered, which in theory has a 100% recession signaling rate. Okay, and that's why the markets got scared last year. I think the key takeaway is that, you know, today's print, of course, is expected at 4.2. I think 4.3 is going to scare the markets. Okay, the reality is that, you know, we are at a time now where, and I'll show you an interesting chart in a minute, but we're at a time where the data out of the US has been slowing. Okay, if we look at the city index, you know, the surprise index about the economy, it's actually been showing quite a bit of weakness over the last 2 months. So there's a very interesting setup where we almost look like we're repeating what we did April, May, June, July last year, and I'll show that to you in a minute. But the key takeaways from today, I think a 4.3 print is problematic. It will scare the equities in particular. They are sensitive. 4.3 will raise a couple of eyebrows as to, well, hang on a sec, you know, is the Fed now pivoting back towards a more hawkish stance at a time when in actual fact labor markets continue to slowing? Okay, so 4.3 is problematic. 4.4, all bets are off. 4.4 will effectively trigger the SAM rule, so we will have recessionary type fears should we trade 4.4% today. Okay, on the converse of that, okay, if we downtick to 4.1, it really does justify the hawkish stance from the Fed. It will of course test that 470 yield level in the 10-year, and you very, very much want to be watching what happens around that point. It's very much going to be a case of today, do we hold 470? Okay, if we hold 470, close above 470, 10-year is got clear blue skies up to that 5% yield, and that's also going to be very problematic for the equities. Okay, now hopefully you've taken away something that you would have leaned on it, which is a good number. 4.1 is problematic for equities, a bad number is problematic for equities. The point is today seems to be one of those scenarios where equities are going to have a tough time either way. Should that unemployment rate tick up, like I said, to 4.3, 4.4, or tick down to 4.1. Okay, I think the only scenario in which equities sort of survive today is very much bang in line, you know, 4.2 as well as the headline number at around 160. Talking of the headline number, what to expect today? Well, there's a couple of things to look at here. Expected is 160 with a range of, you know, anywhere between around 120 up to around 240, depending on if you look at Bloomberg or at Reuters. The point is, and again, the absolute number here is not as important. It's the absolute number relative to what we've been doing. Okay, you can see the purple line. That is the 6-month average, and you can see for the last 6 months it has been trending from around 220,000 all the way down to 140. Okay, the trend is very clear. Less jobs. That's the key takeaway. The number that the Fed tends to lean on, and Powell has told us a number of times, is 100,000. Okay, they believe 100,000 jobs is necessary to keep the unemployment rate from ticking up. So any number below 100,000, all bets are off. Recessionary play is in play. Curve is going to steepen, led by the front end, and of course equities will nosedive as a result of that. So keep a very, very close eye on a number below 100. I think any number above, like I said, any number between 160 and 200 is okay for equities. Okay, it's not too hot, it's not too cold. It very much just showcases the US economy is still thriving and very, very strong. Any number above that, 225, 230 mark, I think that calls into question a higher yield environment, and that's going to be problematic for equities. Okay, so like I said, the equities today are okay, a number between sort of a 150 and sort of 180, 190. Above that, you are going to see yields rise, and that's going to be problematic. Okay, the key takeaway in terms of proxy markets today is watch the yields, watch the 10-year, and trade the equities off the 10-year. That's going to be the clue. It will tell you what to do in terms of trading equities. Now, turning our attention to earnings, I think this is the first time in a while I'm actually showing this chart, and it's because I suspect that earnings could start to play an interesting role perhaps in terms of the inflationary discussion. It's expected today come out bang in line 4%, but there is some talk of wage pressure starting to come back through into the economy, so keep a close eye on that. Tick up to 4.1, again, that's a head scratcher. That's very much going to send some sort of signals that perhaps the Fed does have inflation that is stuck, and perhaps we continue to see this very, very hawkish stance. So 4.1, don't be surprised to see bond yields also test that 470 yield. As you can see, it has very much been doing nothing for the last couple of prints. So start to tick up. We are going to start to see a new trend develop of year-over-year higher wage demands, and that is going to feed into inflation at some point over the course of the year. Now, two key charts to pay attention to. One, the city index. Okay, what I want to showcase to you is if you look back at last year, particularly April, May, June, all right, cast your minds back, that's when we started to see the city index, the surprise index, start to move below zero. And it was when we got to July that we got that really bad non-farm payrolls print, and that was the lowest we saw the city index all of last year. That prompted the Fed, of course, to begin the process of cutting quite aggressively. Now, like I said to you, you can see that for the last 2-3 months, we've started to see that slowing again. Okay, and I think that contextually matters because it comes at a time where equities are euphoric. Everyone is euphoric about the US economy, and effectively we are seeing a slowing in the US economy. Again, like I said, any number around that 120,000 mark in the non-farms today is going to prompt some fear factor, and if the unemployment does tick up to 4.3, 4.4, all bets are off. Okay, this thing is going to sink quick, and we are going to start to see recession plays put back on. Now, our final chart and a key chart to pay very close attention to, I did post a tweet about this. This is what you want to look at. Okay, this bottom chart in the purple is effectively the 2s, 10s, and what you can see is a very dramatic steepening. Do not discount this. I far too often see people talking about the 2s, 10s at the wrong time. If you go back and you look at particularly, sort of the 2008 recession, and you look at the key sort of big recessions, what you typically see in the curve is it's sort of in terms of sequencing, how the curve steepening works is first it's ultimately led by the back end. So what happens is back end yields start to rise. Okay. The second part of that is what happens is because of higher back end yields, that prompts ultimately recessionary fears, which then forces participants to start trading the front end of the curve, and they start buying up the front end of the curve and driving down front end yields. And that is what exacerbates and creates a very rapid rate of change in the steepening. Okay. This on its own, a 41 basis point steepening over the course of the last 2 months, at a time when the US economy is slowing, as per the city index, is problematic. It doesn't matter how you want to argue it, it's a problem. Okay, now I've seen a couple of economists coming out this week say, the rate of change is prompting them to not necessarily look to take the flattener, but they expect a little bit of profit taking in the steepener play. Now, this is the key to watch today. If that curve steepens out today again, keep a very close eye. Okay, there's going to be some fear coming to the market as a result of the steepener play. Okay, these higher yields that we're seeing in the back end, they are a problem. Okay, and when they become a problem is not necessarily when they stay up here for 1 day or 2 days. It's when they sit up here for a week, 2 weeks, 3 weeks, a month, a couple of months. Okay, that's when they start to become a little bit of a tightening or de facto tightening on the US economy, and the result eventually is we get some form of a recession. Okay, so keep a close eye on this. I'm not saying we're in a recession. The US economy is still relatively robust, but some of the signs there are that we are seeing this weakening, and it's coming at a time when back-end yields are rising, and that is only going to add further problems for the US economy. Okay? That's the key takeaway. That being said, I think it's very obvious. We're trading at 470. It's in a massively important yield for the 10-year. Just watch the 10-year today. That's going to give you all the clue you need to know. We break above that 470. We see some really aggressive sell-side action in the bonds. Don't be surprised to see us pop up to that, towards that 5% over the course of next week. What does that mean for the markets? Well, it's not positive for equities, I can tell you that much. Keep a close eye. Of course, today does have all the hallmarks of fireworks, so be cautious, manage that risk. Okay, there's going to be a lot of tradable opportunities over the course of next week, so just make sure you're aware that there is going to be a heightened volatility today over the non-farm payrolls. Okay, and that being said, manage that risk, go make some money.